Hi everyone, welcome to ACFI1003 Introduction to Finance Topic 2, Commercial Banks. What we did in the last topic was we had a look at the financial system overall, and that included financial institutions, the financial instruments, and financial markets. So what we're going to do in this topic, as well as next week's topic, is have a look at the financial institutions in more detail, and this week we look at banks. So what we're going to have a look at in this topic is what banks do. We're going to look at where banks get their money from and what banks do with their money. We're also going to look at the other services provided by banks, which we call off-balance sheet business. We're going to look at the main risks that banks are exposed to and talk about the supervision of banks by the regulators. And what we're going to do as a part of that is we're going to look at capital adequacy standards, which make sure that banks have enough capital to protect themselves from many of those risks. So let's start off with what the main activities of banks are. Banks are arguably the most important of all financial institutions, and one of the reasons we argue that is because they hold more than 50% of all assets held by financial institutions. Modern banks provide a full range of financial services. So for example, banks provide their customers with different types of bank accounts, different types of loans. For example, an individual might have a car loan or a mortgage loan to buy a house, different types of investment products, insurance policies, financial planning services, as well as other services. The activities of commercial banks today are far less regulated than what they were during the period of the 1950s to the 1980s. Now, during that period, the government tried to control the economy by controlling banks, and the way that they controlled banks was by deciding who banks should lend money to and at what rate. These regulations prevented banks from growing, and other financial institutions such as finance companies or building societies, for example, began offering these services and started to grow at the expense of banks. For example, banks were encouraged to lend to business, but not to individuals for either a car loan or a home loan. So what we saw happen was building societies and finance companies which were offering these services were growing at the expense of banks. Now this occurred till the 1980s, where in the 1980s we went through a period of deregulation, and a result of that deregulation, this allowed banks to offer these services, and by doing so, the banks regained market share. Now, in this less regulated environment, what banks do is a practice called liability management. And we'll talk a little bit more about liability management, but basically what happens there is if banks don't have enough deposits to cover loans, then they borrow in the capital markets. And also one other thing that's important to consider with banks is following the GFC, the global financial crisis, the regulation of the banking sector has attracted new attention. So what do we mean by this liability management and asset management? Well, let's start off with asset management. Asset management occurred to the 1980s, and what it basically meant was that banks would lend money based on their available deposit base. So their loans depended on the balance of their deposits from customers. Since deregulation, however, banks have moved to a practice called liability management. So what they now do is they look at the demand for loans. So if the demand for loans is higher than the deposit base, then they look for other funding sources to manage that loan demand. So what they basically do is they borrow that extra money from capital markets. And what we've also find with banks is they provide many other financial services, as well as a lot of off-balance sheet business, which we'll talk about shortly.